Good afternoon, everyone. I'm Jim Kokolas with Caliber CPA Group, and it's my pleasure to welcome you all to our 2023 Employee Benefit Plan virtual conference. Today, we have an impressive lineup of speakers, including our own experts from Caliber, as well as our distinguished guest, Sharon Goodman, Principal at Slevin and Hart PC. Together, they'll be shedding light on key insights for enhancing the regulatory compliance and efficiency of employee benefit plans. Before we dive into the conference, here's a quick overview of what to expect today. Following the presentations, we'll be hosting a Q&A session, so please feel free to submit your questions in the Q&A window at any point, and we'll do our best to address them at the end of the conference. For those seeking continuing professional education or CPE credits, please be on the lookout for polling questions that will appear throughout the conference. Answering these questions is necessary to meet the CPE credit requirements. Post-conference, we're going to send an email to everyone guiding you on accessing the program materials and to claim the 2.5 hours of CPE credits. So without further hesitation, please join me in welcoming our first speaker. David Kim is a senior manager in our payroll compliance department. David has nearly 15 years of experience and expertise in business analysis, auditing, and program management. In addition to performing and supervising fieldwork conducted on behalf of Caliber's multi-employer benefit plan clients, he also oversees the training of new auditors, administers many payroll audit programs, manages team assignments, and serves as a daily point of contact for numerous clients. So welcome, David.
Thanks, Jim. So before we get started, just want to say thanks again and thank you to everyone that helped put together this conference. And just to give a little bit additional background info, I guess I'm referred to, some people would call it a boomerang. I started with Caliber as my first job out of college 15 years ago. So I have payroll auditing experience from, conducting the audits all the way up to reviewing. So I have the experience from basically start to finish in all components of payroll auditing. So today I'm here to speak to you about payroll audits, and here are a list of the topics that we'll cover today. First off, we have the purpose of payroll audits. Next up, we'll discuss in-house versus service provider payroll audits, the administrator's role in payroll audits, and then we'll wrap up with audit frequency, how any advice for employer self-audits, and we'll have a discussion about some of the common errors that we typically find when we conduct the audits. All right, so before we jump into the payroll audits, we just want to give a brief background as to how they came about. So ERISA, I'm sure some of the folks on the line has heard about. ERISA stands for the Employee Retirement Income Security Act of 1974. So ERISA requires plan management, a plan board of trustees to pursue collection of delinquent employer contributions. The trustees ensure that the plan has a detailed collection policy that includes procedures for auditing employer contributions. So without this, it'd be pretty difficult for any plan to ensure that employers are complying with the collective bargaining agreement or CBA that they have agreed to. And last on this one is the audits can be conducted internally or externally. So in reference to one of the topics we had earlier about in-house versus service providers. Next up are the objectives of payroll audits. So the first one is verifying the accuracy of the contributions collected. Next up is census data participation records. So this is important because sometimes when we go through payroll audits, we can see that names get transposed, or we've seen a lot where sometimes a father and son are within the same employer, And if they have similar names or one's a senior or junior, then sometimes their contributions can get transposed. Another thing would be updating, if someone has a life-changing event, like they get married and they change their last name, um, getting those types of records updated as well. Another item that is verified is providing assurance that contributions have been made in accordance with the collective bargaining agreement and the plan trust documents. So those are the objectives of the payroll audits. Next up is the scope. So typically for the scope of our audits, for payroll audits, we will ensure that all eligible payroll hours are remitted at the correct benefit rate. So that can be a myriad of things. Depending upon what the fund is and what the contribution basis of it is, depends upon how the testing will be conducted, as well as making sure that the employer is contributing on the correct basis. So for example, like if there was, let's say, a cap on how many hours can be reported for a certain individual, did they apply that cap correctly? Or conversely, if there was a minimum of hours that were supposed to be contributed, were those contributed correctly? Next up is determining whether all eligible employees are reported to the plan. So this one is ensuring that the bargaining unit or whomever job classifications were bargained as to what is going to be covered under the collective bargaining agreement, ensuring that all that work or whatever bargaining unit was agreed upon to be contributed on is actually being reported on. So we'll discuss this in the common errors later on, but often we do see issues with employers not understanding, or people that have signed their collective bargaining agreements and the people doing the contributions not having a clear understanding as to who is actually eligible for contributions. So often it's an education issue in regards to trying to get the correct individuals that are eligible for contributions to be reported correctly. So we do see quite often one of our most common issues is that employers think that, if it's a right to work state, they didn't join the union, that they don't need to contribute on those hours worked or whatever the basis might be. But if you read the collective bargaining agreement, it's based upon what type of work or the classification that they're in, and there needs to be specific language in regards to whether or not you can actually opt out of any of the fringe benefits that are attached to that CBA. The last bullet point is test whether or not subcontracted services are properly reported to the plan. So again, going back to not just job classifications, but also the types of work or whatever the services are rendered that qualify underneath the agreement that the employer signed to. So let's just take a random example of like a mechanic. If for some reason they are understaffed or need to get a project done, or there's some type of technical work that they're not able to do, they might reach out to a subcontractor to complete that work. However, that work might fall under the collective bargaining agreement, which actually, because it was work that's defined within the agreement, it should have been contributed on. So those are the kinds of things that we would test in our scope, and how we go about doing that is requesting kind of our like standard list of documentation that we request to be able to test the scope. So first we start off with the payroll registers, because that's usually what is driving the contribution basis for most of the CBAs that we deal with, because the majority of the contributions that we audit, it's based off of how many hours, you know, a person in the collective bargaining agreement or in that classification worked. So for example, if they worked 1 hour, or they might be owed $1 to pension for every hour they work. So we would need the payroll registers to ensure that the hours that are reflected on payroll is what was actually remitted based upon the rules of the CBA. And then to get to, to ensure that the the payroll registers are accurate, we'll request tax documentation to validate the payroll. So we request a myriad of different tax documentation. For our purposes, we find that using the W-3s and W-2s works best and is the most effective for our testing purposes. But we do also request 940s, 941s, state unemployment records, and sometimes we even need to request daily time cards because the contribution basis is, if they work that day, then they get maybe like a flat rate of $8 for that day. So we would actually need to dive into daily reports to verify that all the days that were worked were contributed on. Also, we will, last thing would be general ledger or cash disbursement journals. And that's where we would test to find a lot of the subcontractors, as well as 1099s, to verify that, making sure that any of the, possible other services rendered were captured. All right. Next up, we have the benefits to the fund. So the benefits to the fund are to ensure that proper contributions are remitted, verify accurate and complete participant records, promote timeliness in recognizing and reporting errors, discover whether subcontractors are performing covered work under the CBA. So I've kind of discussed a little bit about, the results of the audits and how we go about them, and what it does, the advantages for the fund in regards to what the payroll audits are for. So again, making sure that all the hours that were eligible were reported correctly. And then again, my example about, people with similar names, or if they had their last name changed, or even sometimes we see people listed with their nicknames, or it's pretty rare to see a wrong social security number, but we get those kinds of items updated as well, because some of these reports that get sent in are filled out manually by hand. So, and it's entered in manually by an individual. So there's always a chance for clerical errors. So the payroll audits will clean those items up as well. Promoting timeliness and recognizing reporting errors. The payroll audits, the fund, the administrators know when the payments are coming in, so they can kind of have a sense of the timeliness of errors and reporting errors. But that's another portion of what we do for the payroll audits. And then the last bullet point, we look at invoices and ask for services rendered to determine whether or not that if we find any subcontractors that are potentially performing covered work that's under the collective bargaining agreement, we'll ask for invoices and ask for any services rendered to get a deeper understanding as to whether or not those subcontractors need to be contributed on. All right, I see the first polling question came up. I'll give everyone a couple moments to fill that out. All right, so the next up, we have the benefits to the employer. So again, it's pretty much mirrors the benefits to the the fund itself, making sure that they're accurate because, these are people's benefits. It could be their health insurance or their pension, and, ensuring that it is accurate, it's to the members, benefit. Because let's say that they thought they had, all these hours towards their retirement, and those contributions weren't, remitted accurately or weren't remitted at all. So payroll audits would capture these errors and bring them to the attention of the fund administrators and the board of trustees. Again, in the same vein of promoting the timeliness, making sure that items are remitted in a timely manner, as well as getting any errors corrected in a timely manner. The payroll audit programs, they really, from our experiences, they keep the employers honest. It also keeps them on track with the terms specified in the collective bargaining agreements. It also, I think it reduces any suspicion that they're not fulfilling the terms of their collective bargaining agreements. Also, we do recommend that any new employers that are joining the fund and have signed a new collective bargaining agreement, that they tried, we would recommend that they be audited earlier on. So just to make sure that they're actually completing their contributions in the correct manner. So we don't want them to, have their first audit 6 years after they've started and they haven't been doing it correctly for the past 6 years. So we would always want them to start off on the right foot. And then knowing that the payroll audits are going to be conducted, at the end of the day, we're auditing. I don't know too many people that enjoy being audited. So it's not like it's music ringing to their ears when we call up these employers to try to schedule payroll audits. But we do see that, like I mentioned, it keeps them on track, and sometimes it's a bit alarming to them as to how they interpreted the collective bargaining agreement and how they should have been remitting their contributions. Also, it also ensures that no employer has a competitive advantage. Employers that don't pay to the required fringe benefits have an economic advantage over the ones that do, right? Because it's not an insignificant amount of money that that the employers are spending on these benefits. So if they didn't remit any of them, then they would have a lot more cash on hand to do what they're going to do with it. So ensuring that they're actually completing their obligations. Another one would be just to determine the plan liability upon termination. And again, I just want to reiterate that we do recommend that any new employers get audited early so that they don't have a long history of mistakes. All right. So that brings us to in-house versus service provider considerations. So some of the advantages of in-house payroll audits is that they have direct control over the audits, as well as they have control over how their employees are educated on how to conduct the audits, as well as collecting the data. The biggest advantage of having in-house payroll audits is that they have immediate access to all the pieces of the puzzle that they need. So if they were to have a service provider conducting the audits, the service provider might still have to reach out to the fund or the fund administrator to get clarification on how to proceed forward with certain items, or just requesting documentation, because it's not common where the service provider gets complete access to the database as to where all of the information is stored. So, completing those requests could be a bit of a disadvantage for having the outside, the service provider. But the big advantage, the converse of that, is that everything is on hand for the in-house, if it was to be conducted as an in-house payroll audit. Some of the disadvantages, it could be more costly, depending upon what it's going to cost to create the program for conducting the payroll audits, the training of it and the turnover. So those are some of the key disadvantages, is that, it requires a lot of training and just dealing with turnover. The work can be repetitive. But and I forgot to mention, another one of the in-house advantages would be that if they aren't working on specific payroll audits, they could be helping out in other areas within the fund itself or the company itself. So those are some of the advantages and disadvantages of in-house payroll audits. All right, so some of the advantages for a service provider payroll audit is that it can be cost effective. Often it can increase efficiency. It establishes templates and procedures and experts in providing service. Basically, there's no training curve, right? Because the service provider already has the experience and an established program. So outsourcing it could be more cost effective because of the initial costs of building up the in-house training program or the audit payroll audit program. And then some of the disadvantages could be that you're limited to controlling the audits, as well as time monitoring and managing of the service provider. So when we're as a service provider with the experience of being a service provider for payroll audits, we're at the mercy of getting things from someone else. So that can greatly impact our timeline as to when things can get delivered. And another advantage and disadvantage, kind of both, and I'll speak first from the service provider side of it, is often we have to reach out to the firm administrators to assist in getting records, or even just getting the employers that have been selected for audit to provide the necessary documents for us to conduct the audits. And, sometimes, we go through the process of the notification letter goes out and they're notified of the audit, but often they're still questioning as to who Caliber is and why we're reaching out to them. So it takes a little bit of time to actually get to the point where we can start the audit, as opposed to if it was in-house, then it's kind of, you already have those relationships because those remittances are coming in. So often those would be your contacts for the audits themselves. So it would probably be much easier to schedule the audits, but that's just an assumption of mine since I haven't been a firm administrator. So but I would assume that it would be much easier to begin conducting the audit from an in-house perspective, as opposed to using a service provider. And also, again, going back to the cost, it could be cost effective to use a service provider because, if an internal audit program doesn't run efficiently, then it could end up, costing a lot more in the long run if you just used an outside service provider. All right. So the administrator's role. What is the administrator's role in the payroll audits? So they have a lot of duties. Establishing and monitoring the payroll audit program, as well as monitoring the collection policy, ensuring that the plan is receiving all employer contributions. So making sure that there's no delinquencies and things are coming in a timely manner. Ensuring that the participant data is accurate, um, and monitoring any employer compliance with the plan collection policy. As I mentioned, monitor any delinquencies and maintaining an active list of employers. So uh, another big piece of the administrator's role in the payroll audit program is which employers should be audited. From our experience, typically it is random. Um, there is usually a 5-year window with a 3-year audit period. That's the typical cadence that we see. So every employer should be audited at least once every 5 years. And the audit period will be 3 years. So, for example, an audit today probably would be for January 2020 through December 2022. So that, and then usually employers will, the firm administrators will choose employers at random, or they might stratify their selection process by weighing, the size of membership or whether or not they are new to the fund itself. And then the next one up is the targets. So target audits mean that they know that an existing issue is there, or the employer is going out of business, or they are withdrawing from the fund. So that would typically trigger a target audit, meaning it might be within that 5-year window that they would go to, but target meaning that there is a specific reason as to why you know they're requesting the audit of that employer. So usually it would be discussed in like a board of trustee meeting, or the firm administrator might notice that an employer has gone delinquent, or a local business rep might get word that they have this giant construction site. They know that there's all these other employees working there, but for some reason they're only reporting one person, uh, you know, which is probably outside. Those people probably fall in scope, and they're trying to figure out as to why there's so many folks there. Again, the frequency of the audits, as I mentioned, it can vary. Every fund has their own policies and procedures as to what the frequency of the audits are. But like I mentioned, the typical cadence that we see is every 5 years, and then the audit period will be 3 years. Another thing that the administrator will do is weighing the cost of an internal versus external audit program. And then they're also going to lead in regards to figuring out if they are going to charge liquidated damages or interest for any of the audits. So if it makes sense if they're going to charge damages or interest, because if they're recovering funds, for example, for my example, the current audit period would start in 2020. So if funds hadn't been remitted and it's been over 3 years, there's potential for interest that could have been earned on that money, which, that was missed out on. So those are some of the items that the firm administrator will take into consideration for whether or not to charge those for any findings for delinquent employers. All right. Audit frequency. So I alluded to this earlier, talking about the timelines. But it's also, I guess we get this question once in a while. The Department of Labor does not specify whether or not what the frequency is. It's really up to the fund's policies and procedures, as well as if you do use an outside source to conduct the audits, they can work together to figure out what the best strategy is to for conducting the audits based upon the size of the membership and how many employers there are, and based upon geography as well. So again, the audit frequency really depends on the plan. We've seen some as short as a year as the audit period, and others that, and I think we had one recently that went back to like 20 plus years. That was an interesting one, but it really just does vary. And also, the target audits could fall into an ad hoc audit where the plan suspects that there are any potential issues, as well as some policies and procedures have it in there where if an employer had an audit and it resulted with, let's just say, with $5,500 worth of findings that were owed. So there might be a clause where it triggers that if they had more than $5,000 worth of findings in their prior audit, then they get audited within the next 2 years or 3 years, as opposed to going through the 5-year cycle. So, sometimes we'll see employers that have some issues might get audited more frequently. And also, it just really depends upon the scenario. And I would also put in again that any of the new employers would fall into that as well. All right. So self-audits. We do recommend the funds discussing with their membership or their employers that they conduct self-audits. A lot of the issues that we encounter could have been remedied if they just conducted a self-audit. Like I said, a lot of the process is done manually, so there's going to be chances for clerical errors. From my experience, when I first started, there was a lot of paper and manual records, and now that everything's moved to digital, especially after COVID, I feel like the majority of employers have some way of having digital records. So that's been an advantage to us recently, but again, we do encourage that employers self-audit because it really could, prevent them from having to deal with any findings or interest or liquidated damages. And also just ensuring that remittances have been completed in a timely manner, making sure that the pay periods are correct, as well as the check dates. So, for any firm administrators that might be listening, we recommend that you consider maybe creating like a checklist for employers so that they have a process or a checklist that at least that you're looking for when the remittances are being sent in, so that that they had a checklist to go through all the items to ensure that it was complete and correct and timely. All right. Last up is the common errors that we see. So here we have a list of some of the common errors. I've kind of already alluded to some of them already throughout. So from experience, we find that it's pretty rare that we see employers trying to purposely, be delinquent or trying to trick the system, per se. Usually it's just that the education wasn't there, or someone made an assumption at some point, or but I would say the bulk of the errors is that the individuals completing the remittances just didn't have a complete understanding as to what the collective bargaining agreement entailed. So some of the common things, as you see listed here, delinquency, missing hours. One of the ones that we do see often is an incorrect probationary period applied. Often employers think that their internal probationary period for like firing without cause also applies to their fringe benefits. But, unless it specifically says that the fringe benefits are not contributed on until the probationary period is completed, then, they are from date of hire, and, we do see those errors quite often. And as well as, we spoke about the subcontractors. Sometimes they feel like they weren't able to do the work, so they had to find someone else. Since they aren't an employee, they didn't have to contribute on those services. But if the service is covered under the scope of the agreement, then they do owe contributions for those services rendered. And again, I'll just reiterate, a lot of the time, the biggest issues that we do see is that, the education part of it. And it's just human error that we encounter often. And it can be challenging, because sometimes, it's not a pleasant thing to find out that you might have been, doing your job wrong, getting news from an auditor saying that, hey, you might not have done this correctly. So, all right. So that brings me to the end of my time. And the last question.
I think we have one more polling question there. Okay, well, thank you, David. That's really good information. Our next presenter, Mary Margaret Prange, CPA, is an audit partner at Caliber CPA Group. She'll be providing an auditing, accounting, and tax update for us today. With her extensive experience in employee benefit plan audits, Mary Margaret is not only a seasoned auditor, but also a respected educator in her field. She's a regular presenter at seminars and conferences and has developed several courses on auditing, accounting, and various other programs. Welcome, Mary Margaret.
Thank you so much, Jim. Great to be here with everyone today. Always the favorite topic to keep everybody engaged during all the technical updates from an accounting and auditing and tax perspective. So we're going to be looking first at accounting standard updates. You thought I was done talking about leases, but we're still going to spend a little bit of time on that. I think this will be kind of our last time looking at leases. I think all of the implementation will be complete by the time we have this conference next year. We're going to look at one accounting standard update from 2020 as just a refresher, a couple from 2021 and 2022 and 2023. There haven't been a lot of new accounting standards coming out the last couple of years. So the FASB's kind of taking a break on us right now, which is great because they've had some pretty extensive things come out in a couple of the years before the most recent. All right, so we are going to look at leases again. So basically, as I mentioned, implementation was required for nonprofit organizations and, of course, employee benefit plans for the calendar year ends of December 31st, 2022, and then 2023 fiscal year ends. And this was after a very long lead-in period. This accounting standards update came out back in 2016. It was an exposure draft even before that, many years ago. I feel like I've literally been talking about leases my entire career. We did get a 1-year push from COVID for implementation, but this was the year it had to be implemented. So prior generally accepted accounting principles required a straight line presentation of lease expense for all leases, but recognition, measurement, and presentation of the leases was different depending on whether you had what they called an operating lease or a capital lease. Therefore, only the capital leases contain kind of a balance sheet implication or activity. Leases for space would very rarely meet that capital lease definition because typically leases for space are not more than 90% of the total of the kind of operating time frame of lease spaces. So mainly the capital leases was for equipment type leases. But now essentially all leases over 12 months are required to be reported on the balance sheet as a right of use asset and a lease liability. The liability is going to be equal to the present value of the lease payments, and the right of use asset essentially equals that liability, subject to any direct cost or during the transition period when you're implementing the new standard, the remaining amount of the deferred lease and lease incentives that you had on the balance sheet do get taken out of that right of use asset. So you will oftentimes see that the right of use asset during the implementation period does not equal the lease liability because of that. It'll all work itself out as you kind of move through the lease. So going on to our next slide, just looking at the implications for the income statement. The main difference is going to be related to whether you're looking at it either an operating lease or now what is referred to as a finance lease. So if you do have an operating lease, that's going to be more like your straight line expense over the course of the life of the lease. If you are dealing with a finance lease, that is going to result in a more front-loaded expense pattern, but eventually kind of working itself out through the course of the lease. For lease space, it's really going to be hard to meet that definition of a finance lease. So that's mostly going to be operating. And I think that's what I've seen with my clients is mostly we're dealing with operating leases, maybe just a few capital leases if they do have some significant equipment like a copier or a postage machine or something like that. So for that lease space, it's going to be hard to meet that definition of finance. So that is really going to be your operating leases. Now, what happens for lessors? So moving on to the next slide, really not much change here. This is going to be similar to current GAAP. So these leases and agreements are still going to be classified as either operating, direct financing, or sales type, and depending upon what's classification you're using, that's going to impact the ultimate accounting for that. So really not much change there. So let's dive into a little bit of the disclosure requirements, what's going to be required here for leases and of course subleases that might need disclosure as well. So a lot of information was already required to be disclosed in the footnotes about your leases, but there has been some other type of information that's now required because of the new lease standards. So specifically, you're going to be including just a general description of the lease or all of the leases that the entity has, the basis and terms and conditions on which variable lease payments are determined, the existence, terms, and conditions of any options to extend or terminate the lease. And that is going to be one of the significant new pieces of information. And the reason why it's so significant is because part of the calculation now of the right of use asset and the lease liability is going to come down to assumptions that are made as to whether the organization is thinking about extending the lease if there's an option in there to extend or terminate early. So that will factor into the overall calculation of what's put on the balance sheet for the right of use asset and the lease liability. Existence and terms and conditions of the residual value guarantees that would need to be disclosed, restrictions or covenants imposed by leases as well. A few more disclosures on the next slide, just looking at the information about leases that haven't yet begun. So if you have negotiated a new lease before the end of your fiscal year or calendar year, but it hasn't started yet, you would need to include information about that in the footnotes for the organization's audited financial statements. And then any information about significant judgments and assumptions made in the accounting for leases. So this is some other significant, very new information that would need to be disclosed. So looking at whether you've got contracts that contain a lease, the allocation of the consideration in the contract between what's considered the lease and non-lease components, you would need to disclose that. So if there's any kind of like service component of the lease payment, and then ultimately the determination of the discount rate, which is going to have a significant impact in the overall calculation of the present value of the lease payment, which is your lease liability, and then of course factors into that right of use asset. A few more things to talk about on the disclosure requirements. If there are any terms or conditions related to any sale leaseback transactions, I mean, that was already required to be disclosed in the financial statements. If anything like that existed, it's still going to be required to be disclosed. And then there is one carve out on this new lease standard that if you do have leases that are 12 months or less, you do not have to go through this calculation of the present value of the lease payments. You do not have to recognize a right of use asset or a lease liability. So if your organization is taking advantage of kind of that practical expedient, you do have to include that in your accounting policies, in your footnotes to your financial statements. So let's kind of walk through some key questions that we've put together to help guide us in this implementation of the new lease standards. This is some questions that we've kind of come up with, but the first one is pretty basic. I mean, are you looking at a lease? Do you have a lease? Generally accepted accounting principles have defined a lease as the right to control the use of an identified asset for a period of time in exchange for consideration. So actually, if you can flip the slide, one more. Yep. All right. So the right to control the use of an identified asset for a period of time in exchange for consideration. That is what generally accepted accounting principles have defined as a lease. So how do you determine control? So they've said control can come from the right to an economic benefit from that asset. So that can include the use of space or the use of equipment, and the right to direct the use of the asset. So those two things are really going to factor into determining whether you have control. So the determination of the right to direct the use obviously is going to require some judgment. I haven't really run across any of these types of things looking at leases where this has been a very confusing type of thing to figure out. I mean, if you're leasing space, obviously you've got a lease. If you're leasing equipment, obviously you've got a lease. The one caveat I would include here is looking at IT contracts. So I have seen some IT contracts where, the IT company is providing a service. They're helping you with cyber type security and maintaining your network and, servers and things like that. But they also might be leasing you hardware. So actual laptops and screens and things like that. So that component of that IT contract is actually a lease. So that's the one kind of trickier one that I've seen as we've kind of maneuvered our way through the first, 10.5 months of making sure this is all captured in the client's financial statements correctly. So that might be one where you want to take a look at and make sure you've got your I's dotted and T's crossed on that particular type of transaction. One thing to keep in mind, if the supplier has a substantive right to substitute the property, which that probably is not going to happen, but maybe with a piece of equipment, they might have the opportunity to substitute. Then ultimately the customer, the lessee, does not have the right to control. So therefore you don't have a lease in that situation. So the next question, how do we figure out what the term is of the lease? So the guidance here is making sure that we look at the non-cancelable period, and that's going to include 3 things. So the option to extend if the lessee is reasonably certain to exercise that option. It's going to include the option to terminate if the lessee is reasonably certain not to exercise that option. And it's also going to include renewables or extensions of lease at the option of the lessor. So right now, I'm not sure any organizations are reasonably certain about decisions for space in particular, just because of what's been happening in the world, especially when you get kind of further out from that 3 to 5 year time frame. You know, we all really have no idea what's going to happen. None of us could have predicted that we were going to go through this whole period with COVID. So there's some judgment out there that's coming into play. And, you know, I think as long as you've kind of taken a look at this and documented what your assumptions are and the judgments that you've taken and kind of the thought process that goes into it, I think that can come into play as you're kind of figuring out what the ultimate term is. Again, making sure that you take a look at this exception to the general rule to recognize leases on the balance sheet as long as they're not over that 12 months. So you can, you know, take advantage of that opportunity not to have to go through this whole process if you've got shorter term leases. So looking at the next question, how do we determine what the discount rate is? So initially when the new leasing standards came out, this was basically they said, you know, it's the rate that's implicit in the lease. Well, a lot of leases that I've seen don't have a rate that's implicit. So then they came out with additional guidance to kind of help us. Well, they said you can use the incremental borrowing rate. Well, again, nonprofit organizations and especially employee benefit plans are not really borrowing money. You know, you're investing money. So there isn't even an incremental borrowing rate to use. So again, more guidance came out. Now they've said you can use the risk-free discount rate at the time of the lease or during this transition period, the date of transition. So if you have a calendar year end of December 31st, 2022, and you had a lease that was in place that was starting at the beginning of 2022, you would have used the discount rate as of 1/1 or whatever the first calendar day that fell on a weekday was for that year. So going forward, as interest rates have been, as we've seen interest rates rising, you know, there is a converse kind of relationship between the interest rate and the ultimate present value calculation. So we're kind of seeing as leases get signed now in 2023, this calculation of the present value is going down because the interest rate that's being used to calculate it is getting higher. But that is the rate that you can ultimately use, you know, when you don't have one implicit in the lease and you don't have an incremental borrowing rate. Finally, making sure that any non-lease components have been taken into account when putting together these calculations. What are these non-lease components? So mainly what we see is equipment leases that includes maintenance services. So those can be allocated, you know, between the lease component and then the service component. So that just needs to be taken into account. Taking a look at the next slide, the initial measurement here, just a little bit of a diagram on how to kind of calculate the lease liability. We have designed a great spreadsheet. One of my partners has put that together. If you need a copy of that, we'd be happy to share that with you. It walks through the entire calculation and pretty much every journal entry for the month of the time of the lease. So you first have to kind of schedule out all the payments and then run the present value calculation. That's going to give you your lease liability. And then once you do that, you can figure out your right of use asset. That right of use asset is going to take into account any direct initial costs that went into the lease and any incentives that were provided. to the organization, to the lessee, for build out and things like that. So our spreadsheet basically walks through that monthly calculation of the reduction in the right of use asset and the lease liability, the cash implications, and the impacts on the income statement. So just a few more things on the leases, just making sure that you've properly made a determination of the classification of the initial lease. I talked initially about, there's a difference between finance leases and operating leases. There's 5 tests to determine whether you have a finance lease. If you don't meet any of these 5 tests, then you're definitely looking at an operating lease. This is very similar to previous GAAP, although that was only a 4-prong test. So they did add one. The first 4 are very similar to what previous GAAP was. They just don't have the specific percentages that we used to kind of hang our hats on when we were making the determination of whether we had a capital lease or an operating lease. So there's a little bit more judgment here. But then this final test for whether you have a finance lease says the underlying asset is of such a specialized nature and would have no alternative use at the end of the lease term. So that I'm not seeing a scenario where that would really kind of come into play for employee benefit plans or really a lot of our clients. But this is something to take a look at. I doubt you're going to meet the definition for a finance lease when you're looking at lease space, but you could with some of the equipment leases. And just kind of the final thing on the leases, just making sure to take a look at the practical expedience. You may be able to elect some of those. It allows you to not have to reassess whether expired or existing contracts are or contain leases. You do not need to reassess whether the lease classification for any expired or existing leases is correct or not. And you do not need to reassess any initial direct cost for existing leases. However, you might have to use hindsight in determining that lease term. All right, so that gets us through leases for what I hope is our final time going through that. And I hope, well, we've got our first polling question here, so I'll give you a second or two to answer that. I hope the implementation for those that have finished it has gone smoothly. And for those that are working through it, it is going through smoothly as well. All right, so 2020, we'll rewind a little back there. Some larger list of accounting standards that came out back in 2020, not a ton that were really applicable to our client base or really even employee benefit plans. This one is more for nonprofits, for those of you that might be working in that space as well. But ASU topic 2020-07 related to not-for-profit entities regarding the presentation and disclosure by not-for-profit entities for contributed non-financial assets, or what we've always kind of referred to as in-kind contributions. So this was effective back for years beginning after June 15th, 2021, but early adoption was permitted. So it's effective now. So you need to make sure you're kind of walking through that. So just flip into the next slide. The FASB was trying to increase the transparency about in-kind services, or what is now referred to as contributed non-financial assets. They really wanted, well, one of the main things they want is financial statements to be more comparative between sets of financial statements. So, like if someone is looking at 2 sets of financial statements, they're going to see the same type of information disclosed so they can kind of compare them. But really, they also wanted more disclosures about the nature of the non-contributed or the contributed non-financial assets. So not-for-profits are now going to be required to provide this additional information on the contributions of the non-financial assets that they receive. These are also known as gifts in kind. Contributed non-financial assets, they can include fixed assets such as land, buildings, equipment, the use of the fixed assets or utilities. It can include materials and supplies such as food, clothing, pharmaceuticals, also intangible assets, and the recognition of contributed services. So flipping to the next slide. One of the main changes is that now on statement of activities, you're going to be required to report them in their own separate line. We used to kind of commingle them with the other contributions. Specifically on the disclosures, you're going to have a disaggregation of the amount by category that depicts the type of contributed non-financial assets. So for each of the categories of contributed non-financial assets recognized, this new standard requires a not-for-profit to disclose about 5 different things. So the qualitative information about whether the contributed non-financial assets were either monetized or utilized during the reporting period. If they were utilized, you need to also provide a description of the programs or other activities in which those assets were used. That's also going to be required. The not-for-profits policy, if they have one, about monetizing rather than utilizing contributed non-financial assets, a description of any donor-imposed restrictions associated with the contributed non-financial assets, that's also going to be required to be disclosed. The valuation techniques and the inputs that were used to arrive at a fair value measure, that's going to need to be disclosed. And then finally, the principal market or most advantageous market used to arrive at a fair value measure. If it is a market in which the recipient not-for-profit is prohibited by a donor imposed restriction from selling or using the contributed non-financial assets. What they did provide is a nice kind of option for how to present this in the financial statements. And I have some examples of that we're going to look at as well. But flipping to the next slide, how is this different from current GAAP? So pre-existing requirements, you really just had to describe the programs or activities for which contributed services were used, including the nature and extent received for the period and the amount recognized as revenues. Now you're going to be including non-monetary information, the number and trends of donated hours received or the service outputs provided by volunteer efforts and other monetary information, and disclosing the fair value of the contributed services received but not recognized as revenues, if that is practicable. Flipping to the next slide, this is going to be an illustration of one of the ways to show this in the kind of the front part of the financial statements in the schedules. So you can show it as a separate line, or if you flip to the next slide, you can show it as its own separate column. Personally, I think all of these columns, as the statement of activities starts to get too many columns on it, it's just too much information to take in. So in most cases, I would offer my suggestion to clients to say, let's just do it as a separate line. But you can choose between these 2 options. So flipping to the next slide, this is going to be kind of the first illustration of the disclosure. So you can, in the footnotes to the financial statements, provide this chart of what the contributed non-financial assets were for the year, broken out by all the different types. You can see building, household goods, food, supplies, services. And then in addition to that chart, if you flip to the next slide, you'll see illustrations where you've provided all of the necessary qualitative information for each of those categories. So this goes on for 2 slides. I'm not going to walk us through all of this, but that would be what you needed to disclose. But if you flip to the next slide, you'll see more. I think this chart is an easier presentation to be able to take all of the information in kind of more at a quicker pace. So you literally have a chart that shows each of the different types, the revenue recognized, how it was utilized in programs and activities, the donor restrictions, and then whether there were any or what the valuation techniques and the inputs that were used to figure out what the value of the revenue that was received. This would be my preference. I think this is just easier to kind of take the information in at a quicker pace as you're looking through the financial statements. Okay, so that's all we had for 2020. Looking at 2021, not a lot going on here. There was one other in 2021 that I didn't list specifically. It was the first one released. It had to do with reference rate reform. That particular ASU, it applies to all entities that have derivative instruments that use an interest rate for margining, discounting, or contract price alignment that's modified as a result of the reference rate reform. So the amendments also optionally apply to all entities that designate receive variable pay and pay variable rate cross-currency interest rate swaps as hedging instruments and net investment hedges that are modified as a result of the reference rate reform. So this is the interbank offered rates, the IBORs, and particularly the risk of cessation of the London interbank offered rate, the LIBOR. So I'm just providing that as a little information for you. In 2021, there also was an accounting standard that came out related to intangibles, goodwill, and other topics. So this is related to nonprofit organizations. If you flip to the next slide, we'll just walk through this one pretty quickly. But the amendments in this update allow an entity within the scope of the guidance to elect not to monitor for goodwill impairment. If you have recognized goodwill, not monitor for goodwill impairment triggering events during the reporting period, and instead to evaluate the facts and circumstances as of the end of the reporting period, so year end in most cases, to determine whether it is more likely than not that the goodwill has been impaired. So monitoring for triggering events during the period was extremely time consuming for organizations, and the effort did not really exceed the value. So this was a little relief that was provided by the FASB. This accounting alternative should reduce cost and complexity for preparers by aligning the triggering event evaluation date with the reporting date, whether that date is an interim or annual reporting date. Additionally, the amendments here provide more relevant information for users because the triggering event evaluation will reflect the facts and the circumstances present at the end of the reporting period for which those users receive financial statements. So bottom line, kind of from COVID relief, this is eliminating the ongoing triggering event analysis and instead allows organizations to evaluate the facts and the circumstances at the end of the reporting period to determine whether goodwill impairment has occurred. So probably not going to be that applicable to too many, but just wanted you to know about that. In 2022, only 6 accounting standard updates. So the FASB was taking it easy on us back in 2022. Most of them have no impact on the tax exempt community, including employee benefit plans. There was an update back in 2020 regarding the reference rate reform. Then another one here in 2022, just talking about in March of 21, the FCA announced that the intended cessation date of the overnight 1, 3, 6, and 12-month tenors of the USD LIBOR would be June 30th of 2023, which is beyond the current sunset date of Topic 848. So this update from 2022 defers the sunset date of Topic 848 from December 31st, 2022 to December 31st, 2024, after which entities will no longer be permitted to apply that relief. So it's only going to impact you if you have a contract that references LIBOR. So not much for 2022. 2023, accounting standard updates. This really just had to do with a little bit more information on leases, specifically common control arrangements. So 2 issues addressed in the ASU related to common control arrangements. Issue 1 is a practical expedience using written terms and conditions of the common control leases. So if we flip to the next slide. In determining if the lease exists under this practical expedient, an entity must determine whether the written terms and conditions convey the practical, as opposed to the enforceable, right to control the use of an identified asset for a period of time in exchange for consideration. An entity is not required to determine whether the written terms and conditions are enforceable when applying the practical expedient, and an entity may apply it on an arrangement by arrangement basis. If there are no written terms or conditions, the entity cannot apply this practical expedient. This is really just going to impact disclosures in the financial statements for leases. Issue 2 related to accounting for leasehold improvements. You're going to have to amortize leasehold improvements over the useful life of the leasehold improvements to the common control group as long as the lessee controls the use of the underlying asset through a lease. Accounting for any remaining leasehold improvements as a transfer between entities under common control through an adjustment to net assets if and when the lessee no longer controls the use of the underlying asset. And that's really it for accounting standards updates. Moving on to some new auditing standards. Not going to really dive into these too much because they really mostly impact us and not so much the clients, but SAS 144, if you flip to the next slide, has to do with the use of specialists and use of pricing info from external sources. So the standard responds to some feedback that was received that sought more guidance on auditing the fair value of financial instruments. It's effective for audits of financial statements for periods ending on or after December 15th, 2023, but early implementation was permitted. There are some changes to the extant AUC sections 501, 540, and 620. It provides guidance regarding when management has used the work of a specialist in developing accounting estimates, provides enhanced guidance about evaluating the work of management specialist. There are amendments made to no longer refer to using the work of an external inventory taking firm as considered as using as the work of a management specialist. But really the amendments here were not intended nor expected to change existing practice. Couple other things here. Section 540 changes. It requires the auditor to take into account the relevance and reliability of information to be used as audit evidence, including its source, and contains an appendix addressing the use of external information sources. In Section 540 has been amended to add a new appendix, use of pricing information from third parties as audit evidence, and that provides guidance on using such information as audit evidence for estimates related to the fair value of financial instruments. There's also an Appendix A, special topics. This really relates to publicly traded companies, so I'm not going to really flow into that. But just some information here regarding utilizing those specialists. One final thing on Section 620, there's some amendments to various application paragraphs in 620 that enhance the guidance related to using the work of an auditor specialist. So we need to take a look at that when we're looking at those specialists. All right, SAS 145, this relates to the auditor's discovery work during the planning phase of an audit relating to assessing the risk of material misstatement and kind of the overall entity and environment of the organization that's being audited. So this came about because of some deficiencies in the auditor's risk assessment procedures. That's kind of been a common issue that's identified by practice monitoring programs in the United States and worldwide related to just looking at audit documentation. But in 2020, U.S. peer reviews said that currently effective auditing Section 315, understanding the entity and its environment and assessing the risk of material misstatement, was the leading source of matters for further consideration, which is basically problems with the audit work that an auditor does. So this ask was issued back in October of 21 to kind of address that. It sharpens the focus on risk-based auditing and takes effects for audits of financial statements on or after December 15th of 2023. Likely, we will be posing more questions about internal controls and just general understanding of the organization. You may notice some additional kind of focus areas for the audit. It was issued to kind of help us determine which areas pose the greatest risk of material misstatement in an audit so that we can spend our time there performing procedures to gain comfort over those numbers and the disclosures in the financial statement. The new standard was designed to enhance the requirements and guidance for identifying and assessing the risk of material misstatement, particularly the areas of understanding the entity system and of internal controls and assessing control risk. But there's not really anything new. It's just providing us more information on kind of how to do this, what to document. It doesn't really, and if we flow to the next slide, I'm on slide 37, it doesn't really fundamentally change the key concepts underpinning the concept of audit risk, but it clarifies and enhances certain aspects of the identification and assessment of the risk of material misstatement to drive a better risk assessment and therefore enhance audit quality. So it includes extensive guidance regarding the use of information technology and the consideration of general IT controls at an organization. It revises the definition of significant risk, includes new requirement to separately assess inherent risk and control risk, which is part of the overall risk of material misstatement definition. It includes new guidance on maintaining professional skepticism. And then finally, and this is kind of one of the more important components of it, it includes this new kind of stand back or kind of macro perspective requirement that's intended to drive an evaluation of the completeness of the identification of significant classes of transactions, account balances, and disclosures by the auditor. So kind of just taking a step back and saying, you know, we've done all this at kind of the detailed level. Did we capture everything? So that's SAS 145. Looking at SAS 146, kind of the quality management for an engagement conducted under generally accepted auditing standards. So the purpose here was to integrate concepts from the new quality management standards at the engagement level. It focuses on kind of that critical role of the engagement partner and making sure they are managing the audit engagement to achieve a quality result. It reinforces importance of quality to all engagement team members, and it's effective for audit periods beginning on or after December 15th, 2025. Flipping to the next slide, just kind of taking a look at key points. The term quote unquote, take responsibility for is used to indicate which tasks or actions may be delegated by the engagement partner. The engagement partner should be sufficiently and appropriately involved throughout the engagement, from the planning phase to the field work to closing down the engagement to presenting the results, going over the findings, things like that. Ensuring adequate resources are provided to take appropriate action. That engagement partner is also accountable for the appropriateness of significant judgments made and conclusions reached in the circumstances. They should review all formal written communications and ensure ethical requirements are complied with. 147, inquiries of the predecessor auditor regarding fraud and non-compliance with laws and regulations. So this would come into play if there has been a transition from one auditor to another auditor, now required to ask about prior auditors' inquiries regarding fraud and on compliance with laws and regulations. There previously were questions in that transition component that would have gotten at these areas. Now these are very specific questions that have to be asked. We must document the inquiries and the responses. It's going to be effective for audit periods beginning on or after June of 2023. And then the final auditing standard new to talk about is SAS 148. This has to do with compliance audits. Not really going to be applicable to kind of the work that we're working with on most of our clients. So I've just got this in there if you want to take a look at it. If you're having trouble sleeping one night, you can take a look at that. And finally, just tax updates, just 3 to talk through with you. New employee benefit plan audit requirement change. This relates to participant count. So a little relief for some smaller plans, probably not going to be applicable to too many that we work with. Some new 5,500 revisions for 2023, which actually includes some deferments of some of the things they wanted to do. And then just a reminder about the updated W4P and new W4R that are applicable for 2023. So taking a look at the new audit requirement change, so participant count methodology for determining eligibility for simplified reporting options is available to small plans, and that has changed. So the new methodology counts participants based on participants with account balances at the beginning of the year rather than the old methodology of counting all eligible participants. So it should help to get some of those plans that had around, just over the 100 count, or maybe even closer to 200 eligible participants, but they don't have that many with account balances, so they're no longer going to be required to have an audit. It is effective for plan years beginning on or after January 1st, 2023. A few things here on the revisions to the Form 5500. So this first one has to do with group of plans define contribution groups. So the Secure Act directed that the Form 5500 be modified to allow certain groups of defined contribution plans to file a single consolidated annual report. The final rule modifies the Form 55 instructions to provide that the filing requirements for large pension plans and direct filing entities, DFEs, generally would apply to those groups. Plans in the defined contribution groups reporting arrangement will be required to report specific individual plan level information on a Schedule DCG. I don't think this is going to really apply to many of the plans that we work with, so not going to cover much more with that. There were some changes to the schedule of assets held for investments that actually was deferred. So the proposed rule contains several content requirements for two of the Schedule H attachments, the schedule of assets held and the schedule of assets held and disposed of, that would have required these schedules to be filed electronically in a structured format so that the information could be data mineable. However, they decided to defer that and include that in their broader Form 5500 modernization project, which is forthcoming. Some information on funding for defined benefit plans. The final rule here contains some changes to Schedule MB, SB, and R for defined benefit plans. According to the agencies, these changes are intended to increase transparency and provide PBGC with additional information and data to more accurately project defined benefit pension plans and PBGC's own liabilities, as well as to help the PBGC conduct more effective investigations. So the final rule here incorporates the addition of the new Schedule MEP, multiple employer pension plan information as contemplated by the proposed rule to generally consolidate Secure Act related reporting for a multi-employer plan filer in one easily identifiable schedule. So Schedule MEP is going to be broken into 3 parts. So keep that in mind as you're kind of walking through things. There was a proposed rule change for M1 that also was deferred. And then finally, this miscellaneous revisions to the Form 5500, this related to the counts, using the participant counts, using the count of participants that actually have an account balance as opposed to eligible participants in the plan. So these are all effective for plan years beginning on or after January 1st of 2023. So for the filings that we're going to be working on next year. So a final polling for my section here. I'm going to flip us to the very last slide. So just a reminder on the updated W4P and the new W4R for 2023. Retirement plan sponsors need to utilize this updated Form W4P for periodic pension and annuity payments, and the new Form W4R for non-periodic payments and eligible rollover distributions for income tax withholding elections. And that was supposed to be for beginning January 1st of 2023. Just a little background information about this. In 2017, there were some changes made by the Tax Cuts and Jobs Act that required the IRS to revise the withholding tables and develop new forms to use to withhold taxes from periodic payments. These forms are used by qualified and non-qualified retirement plans for participants to request withholding on benefit payments that commence in 2023 or later. In 2021, the IRS revised the Form W4P into 2 forms. So it's revised into this W4P and W4R. So the W4P is now used to only request withholding on periodic pension and annuity payments, and 4R is used to request additional withholding on non-periodic payments and eligible rollover distributions. The U.S. Department of Treasury and the IRS received numerous questions on the new forms, which caused the IRS to delay the implementation until 2023. Recipients of periodic retirement payments can give payers a Form W-4P to make or change a withholding election or to elect not to have withholding apply. The Form W-4P stays in effect until the payment recipient changes or revokes the decision. The W-4R is required for all non-periodic retirement payments, so that's going to include lump sum payments. If the recipient wants to increase or decrease withholding from the applicable default withholding percentage. This revised Form W-4P has a few changes. The significant changes include updates to the marital category, modifications to the reporting of other sources of income, replacement of allowances for dependent credits, and addition of a calculation to report a new withholding amount. Finally, that new Form W-4R allows a payee to choose a different rate of withholding by entering a rate between 0 and 100%. However, if no amount is selected, the plan sponsor must withhold a flat 10% rate or 20% if eligible for non-periodic payments. I ran a few minutes over, but that concludes our update. I'm going to turn it back over to Jim.
Okay, thank you, Mary Margaret. I know the leasing accounting change, excuse me, has such a significant effect on the financial statements of so many organizations. So that's really good information. Okay, we're going to take a quick break before we move on to our next speaker. It's about 1:27 right now. So let's do a 10-minute break and we'll resume at exactly 1:37. Thanks, and we'll see you then. Okay, welcome back, everyone. Our guest speaker today, Sharon Goodman, is a principal at the law firm of Slevin & Hart, PC, with a focus on employee benefit plans, particularly multi-employer plans and tax-exempt entities. Sharon brings a wealth of experience in all aspects of employee benefits law, including ERISA and the Internal Revenue Code. Sharon is actively involved with the American Bar Association's Employee Benefits Committee and has served as co-chair of the Qualified Retirement Plan Subcommittee for many years and as co-chair of the Specialized Retirement Income Plans Subcommittee before that. She's also a senior editor, chapter editor, and contributing author of the ABA section of Labor and Employment Law. Today, she'll discuss important and relevant provisions of the Secure Act 2.0. Welcome, Sharon.
Thanks, Jim. Great. We can start there. So like many of you, I'm a professional. I think most of you are professionals rather than trustees, including administrators, maybe. I was just muted by the host. Okay, now I'm unmuted. Can somebody signal that they can hear me?
I can hear you.
Great, thank you. So I'm a lawyer, obviously, not an accountant. So I'm going to approach this by explaining in part the rules, but also how lawyers think about those rules. Unlike maybe some presentations, I am going to try to mention policy. I am going to try to talk about the why of a particular rule that Congress passes or the Department or the Treasury passes, rather than just saying what that rule is. So that means I'm going to focus mostly on what is required, when is it required, what's optional, why or why not should the client decide to do something that's optional, and what's the dynamic. So the Secure Act 2.0 might be confusing because there was a Secure Act 1.0, which really refers to the securing every, and I have to look at it because I don't remember it, securing every community up for retirement enhancement of 2022. The Secure Act 2.0 is the one passed at the end of 2022. Secure 1.0, as it's known, was passed in December of 2019 and started a lot of the themes that we're going to talk about today. Secure 2.0 is really a continuation and expansion of the things that occurred under Secure 1.0. So this is a long list of all of the things that we're going to cover. There are some themes that emerge from what Congress was targeting. And I guess the themes I would say are, first, flexibility for plans and participants, easing up the obligations for participants in terms of access to money, easing up the obligations for defined benefit plans in terms of how errors can be corrected, and to simplify notices, which in theory are supposed to help both plans and participants. But it is a tax bill. I'm at least in Washington, D.C. I recognize that when bills are passed, there are both dollar signs in the plus column and dollar signs in the negative column, and that those bills get rated. And so some of these provisions may not make sense from a policy standpoint. They make sense in terms of putting items in the plus column or the negative column for it to be graded by the government as to cost, which is, in Washington is quite important. Great. So one of the, for those administrators, one of the more practical ongoing changes that Secure 2.0 made was to change how benefit plans can collect overpayments. Overpayments happen all the time. They happen for good reasons. They happen for bad reasons. They happen because participants give incorrect information, whether on purpose or accidentally. They happen for a whole variety of reasons. And traditionally, benefit plans would pursue those overpayments from the participant who received it, obviously. But if the participant had passed away, often from the surviving spouse or from beneficiaries related to the participant. And I think in a couple of, cases which made the news, such as plans taking widows' houses, this made it to the level of congressional attention, which meant that Congress, for the first time in the history of ERISA, other than requiring you to act with your fiduciary duty, have actually added provisions limiting how plans collect overpayments. So this is a case in which one of these small cases in which it gives plans less that they're able to do to collect overpayments. So the rule is described there, but what it really does is limit the methods that plans currently use to collect overpayments. The purpose of or the kind of good news for plans under the collection of overpayments is that, before this change in the law, the IRS or the DOL, when auditing a plan, would often say, you have an obligation to pursue every dollar that you incorrectly pay, no matter how small, no matter how hard, no matter what records you have. Your job is not to pay benefits incorrectly, and if you pay benefits incorrectly, you have to chase that money down. And so many plan trustees were put in a position of having to balance, am I really going to send 3 letters for someone who was overpaid $100 after death? Or am I going to understand that's going to cost me more money than I'm likely to collect, and I'm not going to pursue the overpayment? What Secure does is say to trustees, be rational, be practical. As long as you have good procedures to collect money and you follow them, you don't have an absolute duty to chase every dollar regardless of how much it will cost you to pursue. So like a delinquency, this now goes in the category of, we're going to measure the likelihood of collection and whether the cost of collecting is going to exceed what we're actually going to recover. And our first polling question is up. I'll give you a second for that. And this one's about you, so you can't get it wrong. Okay, assuming you know what your job is, I'm going to plow along. So the important restrictions under Secure regarding how plans collect overpayments is to eliminate a couple of things that plans routinely do, which is, as I said, plans had routinely collected overpayments if the participant was deceased from their spouse, from their beneficiary, from other sources, writing demand letters to the family, which is obviously somewhat disturbing when the individual has just died. That is no longer permissible under, and I'll sort of get to the giant caveat. That is no longer permissible. Plans also routinely charged interest on overpayments. If you owe me $3,000 and I discover 2 years later that I overpaid you, most plans had charged interest on the collection of the overpayment. Not every single plan, but it was relatively common. Congress says, can't do that anymore, can't charge interest. And Congress also says that you cannot pursue the overpayment if you have not figured out that there was an overpayment in 3 years, meaning I can't discover in my records, with an exception, that I overpaid somebody in 2010 and pursue them. Plans were always limited by the statute of limitations in each state about how far back they were likely to be successful, but they could make the demand for the money, hoping that the participant paid and hoping it never got to court. Now the Department of Labor says you can't pursue it if you haven't figured it out in 3 years, unless, and this is a caveat to all of this, unless the participant was culpable. What does culpable mean? Culpable means that you either did something to cause the overpayment, you lied about a fact, you lied about something, and that resulted in the plan paying too much, or you should have done something that would have prevented the overpayment and you didn't, an omission that caused the overpayment, or if I should have known when I got the check that it was too much money and I kept it. Classic cases, I get $100 a month benefit. 1 month I get $1,000, no explanation. I probably should know there's something up and I should contact the fund and return that money. But culpability is a legal standard, and it becomes more complicated for trustees to say, well, was the person culpable or wasn't the person culpable? I think the classic example in our world is suspension of benefits. If somebody goes back to work and does not notify the plan and receives several months of benefits, are they culpable? And because most plans require participants to notify the plan of any reemployment, most plans would take the position that that person is culpable and the rules restricting recoupment don't apply. Next slide, please. Great. So everyone's favorite topic. I feel like I have given some speech in some form to somebody for the last 25 years that talks about the required minimum date distributions, and every single time I do it, the rule has changed. So a little bit of, I guess, background in terms of what the rule is. So the required minimum distribution is the moment that the code, that the Treasury says you have to take money out of your tax deferred qualified plan, get it into your hands, and be taxed on it. This is about the Treasury getting revenue. This is a mechanism to move from tax deferred to taxable. So that's why this date changing actually impacts not just administration, we'll talk about that in a second, but pretty significantly impacts policy in terms of who you think benefits from deferring compensation. So the IRS focuses on when does it come out and how fast does it come out. We're not going to talk about the frequency now, but we're going to talk about when does it have to be paid. The reason we're talking so much about this is the rule is not simple. It's simpler now than it used to be, but the rule is not simple. The rule has changed. It changed in the 80s. It changed in 99, I believe. It changed 2 years ago. It has changed again. It's changing again in 2020, in 2032, unless there's a secure 3.0 and they change it to yet another date. But we'll talk about that. It's also very prone to errors. Almost every plan has an error where they fail to either have an accurate birth date, so they miss somebody reaching the required beginning date. Either they update their records, either they cannot find a person and they've not searched for them, and so they can't pay the benefit. So this is a cause of a lot of hand-wringing for a lot of administrators. So what Secure 2.0, so the original rule, I'll go to before Secure 0.1, the original rule was you had to begin receiving your benefit under the code. The plan could have an earlier date, but it could have no later date than the code maximum. That you had to begin receiving your benefit by the April 1st following the calendar year in which you turn age 70 and a half or retire. Now, 70 and a half is not an intuitive thing that people would think, I'm going to create a rule and I'm going to make it your half birthday. But that's what the rule was for 2 decades. Secure 1.0 changed, extended that rule to be 72. So it changed the end date by which you must start receiving benefits to the April 1st after the calendar year in which you turn 72 or you retire. Secure 2.0 pushes that out even further. So it's 73 if you turn 72 this year, and it's 75 if you turn 74 in 2033. And I think there's an expectation that this may get visited again, and this may get pushed out more. It's now been pushed out 3 times. But the policy is that people are working longer, they are living longer, and as a tax planning mechanism, they want to allow people not to be forced to take their IRAs, not to be forced to take their retirement plan benefits when they're still working, when they're still active and they don't need the money. If you're working, then that date, and if you're not working, that is later of retirement, so you get your benefit. But they want to give people the opportunity to defer that taxable event. A second important piece is that if the plan fails to pay the participant on time, the participant, not the plan, it's a separate qualification issue for the plan, but the participant is subject to an excise tax. That excise tax was 50% for 25 years. Secure 2.0 reduced that tax to be 25%, cut it in half. And if the failure to pay, meaning the money gets distributed within 2 years of the date it should have been distributed, the tax goes even further down. We'll talk to 10%. We'll talk a little bit about the fact that 99.9% of plans avoid the excise tax on participants by relief provided by the IRS, but that's an important feature. I'm guessing accountants encounter this most frequently when there is a failure and they're asked in completing the 5500 or another form to report whether a benefit was failed to be distributed on time. That's what this is talking about. So the core, I was going to give one more piece on the required beginning date. The core thing for plan administrators to think about is, am I monitoring this? Do I have a program and a procedure in place to check to make sure that every fall I'm finding out everyone I don't have a birth date for, everyone who's going to turn, in this case, could be 71, could be 72, could be 73, depending on their birth date. Do I have a procedure in place to find those people, to contact them, and to force them into payment if I do contact them and they refuse to apply? So that's an important kind of take-home assignment in terms of administration, to be sure that you're thinking about this and have a procedure in place. Okay, a topic that has gotten a bit of noise, but probably does not impact our clients in the multi-employer plan very much, and does not impact government plans very much either, only because of the size of the benefits that get paid. Currently, if I, at any time, if I've terminated employment and my benefit is worth $5,000 or less, the plan can force the payment out, send me a check generally, and be done with me. Most retirement plans and defined benefit plans, and certainly most unionized plans, don't do that. They don't force out the benefit at 43 if the individual has severed employment in the industry. What they typically do is they wait until retirement, and at retirement, the person fills out an application, and then they run a calculation, and they say, oh, look, your benefit is $4,500 total benefit for your whole lifetime, all, actuarially shoved together and turns into a lump sum. Because of that, a few things occur. You have no right to choose a benefit with your spouse. You have no right to choose a benefit for your lifetime. You get one check and one check only, and you're off the books, meaning we no longer pay PBGC premiums for you because you pay PBGC premiums for every participant. This person is no longer a participant. They have no expectation of a benefit. And you also often can pay less in administrative fees because most administrators, or some administrators, will charge based on every head they touch, and a retiree would be a check that they would write. So they would charge you for that. So that's fairly standard in the industry for there to be a cash out of $5,000 for benefits worth $5,000 or less at retirement. What the Secure Act did was change that $5,000 amount to $7,000. That's not a significant item. It's not going to result in lots more people getting lump sum benefits, but it will be a slight administrative ease. The policy distinction, and I'll just raise it quickly, is that you always have the ability to have the first type of cash out, one that's paid to someone who's 43. But most plans have not added that because of the administrative issues before retirement. You have to set up an IRA. So you can't just mail a check if it's over $1,000, you have to send an IRA. And so most plans have not done that because there's a headache in creating an IRA, hiring an IRA vendor. There's a whole procedure. So for most plans, this is really about whether at retirement, are you going to increase the chance to lump somebody out to $7,000. Okay, here is another, at least mostly a gift to lawyers who do most of this process. but no plan is perfect. Every plan makes mistakes. There's currently a procedure in place and was before Secure that gave 3 basic options. If a plan discovers a mistake, there were 3 ways to correct it. The first way was self-correction, and these are all called EPCRS. The first was self-correction. I find it, I fix it, I move on. I don't report to anybody, I don't pay a fee to anybody. That's self-correction. Obviously, the easiest method to do is to take care of it yourself. The second is voluntary compliance or voluntary correction program. I complete a filing, I go to the IRS, I ask their blessing, I pay a fee, and they send me a letter blessing what I did. Sometimes not incredibly expensive, but still, it's a filing with a government and not everyone's favorite thing to do during a week. And then finally, there is audit cap, or the audit closing agreement program. And that's where you don't disclose what happened. You don't file for a VCP. You don't correct. The IRS audits you and they catch you. I guess the one lesson of the takeaway is better to correct something before the IRS comes in than after the IRS comes in. Fairly basic. So what Secure did was expand the types of errors that can be corrected through self-correction, meaning the type of errors that I can do, fix, finish, and be quiet about, expanded them to cover a lot more of the practical problems. Plans have errors in loans all the time. There are errors in enrolling people a little bit late all the time. And what the service is saying and what Congress has confirmed is we want you to find it, fix it, and move on. That's the most important thing. And in terms of what now can be corrected, it used to be a relatively limited number of things that can be corrected. Now there are a whole number of inadvertent errors that can be corrected as long as, again, the IRS does not find it first. If you're under audit and the IRS finds it, all of these programs are done. You have to negotiate a settlement of significant money, usually with the IRS. But as long as you find it first and you self-correct within a reasonable period, most common errors are going to be eligible for self-correction. The Lost and Found Registry. There are a couple of things I'm going to talk about today that no one has any information on. So I'm not going to sort of give policy reasons why this makes sense or doesn't make sense. I don't know. Congress is ordering the Department of Labor to create a Lost and Found Registry. The idea being is that people will go online and I guess sort of an Expedia of pension benefits and be able to search for themselves to make sure they don't have a pension benefit they've forgotten about, and then, potentially, I guess, for plans to search for people. It's not clear that it's going to allow plans to search for people or just participants to search for themselves. But there's a long list of information plans are supposed to provide when everything gets developed to create this registry. So don't be surprised if that gets extended. As those of you who write notices, and you auditors are involved in writing quite a few of them, there are lots and lots of notices, many of which overlap in information, overlap in timing, seem overly complicated, to be honest. And I guess Congress has recognized that and is directing the 3 main employee benefit agencies to talk to employers and talk to participants and talk to everybody and gather everyone's best ideas, and then make recommendations to Congress to try to simplify, shorten, condense, improve all of the communications that we have to do every year. Obviously, it's not a surprise to anybody that the PBGC and the DOL and the IRS have a lot of other things going on under Secure. They might not jump to this first, but this is one of the requirements. And in a similar vein, that annual funding notice that the actuary and the lawyer and the auditor work on every year, the goal is to simplify the model. And so, the goal was to modify the model. I would not say that it's simpler. I think the language is pretty complicated, but as a practical matter, most funds currently use the Department of Labor's model for the annual funding notice. If the Department of Labor updates their model, most plans will just use that model. So starting next year, people will begin to use the model. The updated model. And this is effective for plan years beginning now, not that long away, this January, which means it would be for the form that you file for a calendar year plan in April of 2025. So now most of that was either both defined benefit and defined contribution or primarily defined benefit. Now we're going to get into the whole list of defined contribution changes, which frankly were many more changes than impacted defined benefit plans. One, because defined contribution plans are the most common type of retirement plan. Not that many people have defined benefit plans anymore. And so Congress is very focused on how do we allow people to access their 401k plans, the plans they actually have. So currently, if you take out a distribution from your plan and there's no code permitted reason for you to doing it, and you're under age 59, there's a 10% penalty, meaning not a payment to the plan, a payment on top of what you're receiving to the government, to the Treasury, unless there's an exception that allows you to take that benefit early. If you take it before retirement, you take it before age 59 and a half, we consider that to be early. What the Secure Act is focused on is giving people access to money, their own money. I will leave it to you. We don't have a ton of time for policy issues, whether that's a good retirement policy to give people access to their money under a whole number of new circumstances. In my experience, most of my clients are not adding many of these, either because they were exhausted by all of the mandatory distributions that COVID imposed. There were a whole bunch of things you could get money out for during COVID, and they, had to go through all of that, turn it on, turn it off. Most of them are not that interested in adding some of these new flavors of distributions, but here they are. So this is, all right, we have another question. So who do you work with? Since I'm assuming you know who you work with. I'll give you another second and then I will move on. Great. So you're allowed to get a distribution of a particular type and with particular repayment rights for all of these different reasons. So you'll notice that some of these reasons allow you to repay the loan, repay the hardship distribution. For regular hardships, most of the time it cannot be repaid. You get it, you're taxed on it, you pay an excise tax if it's not, if it's early, and you can't put it back in the plan when the crisis is over. Many of these can be repaid to the plan, and they are for varying different reasons. I think the important takeaway for this is that it is generally targeted. If we're going to sort of put legal changes in or code changes in tax categories, required minimum distributions generally help higher income people because they are the people who can make optional decisions about whether they want to take money out of their retirement accounts or whether they have enough money that they don't need to draw on their retirement account and they can defer taxation. These distributions, I think, are generally targeted at lower income people who may have an emergency and need to take out, don't have $1,000 on their credit card, don't have any money to be able to move out of an abusive situation. And so these are emergency things targeted to lower income people. But administratively, the important thing is on the next slide, which is it would be pretty difficult for an administrator to try to prove or receive documents to prove domestic abuse. That's pretty invasive. It asks for a lot of documents. I wonder how that would even be established absent a police report. And so the rule for all of these distributions now has changed to be self-certification, meaning I, as the participant, can tell you that I meet the circumstances. And unless you have reason to know that I'm lying to you, then I can rely on that and I don't have to verify the truth of the reason you've given me for the hardship. So that's a good improvement in terms of process and a simplification of the hardship administrative process. So the next two slides, I guess next three slides are quite a bit of noise about Roth contributions that may not actually impact your day-to-day very much for most plans. So before the new law, an employer could not make a matching contribution or a non-elective, meaning a discretionary contribution on a Roth basis. So pre-tax is an elective deferral, meaning it comes out before I get taxed on the income. Post-tax, obviously, it is taxed, and then all of the income is taxed, and then the money goes to the plan. And there are different reasons based on income level that people would want or not want Roth contributions. So what Secure did was open up the ability for plans to say, yeah, we're going to offer contribution matching and non-elective on a Roth basis. That's a plan decision. If plans want to do that, plans are going to offer that, but it's a choice. It's not mandatory. The thing that I think got quite a bit of the noise is the increase. So right now, people can make catch-up contributions of $7,500. So that means if you're 50 or older, and I want to pay not only the limit, which is whatever, 23,000 this year, I can pay an additional $7,500. So I can really elevate my retirement savings. Obviously, the policy there is obvious. We want people, the older they get, the more you have to save for retirement if you've not saved in the past. And so this is a way to encourage that. In addition, there's we'll call it a super catch-up or a later catch-up. That people who are 60 to 63 have even a bigger amount that they can contribute as a catch-up, again, in order to encourage more savings for people's retirement. The second piece starts up in 2025, but again, it's a consistent theme of expanding the opportunity for retirement, encouraging people to retire. And then our final catch-up, which lots of articles have been written about, and we have a reprieve. So in going back to the idea that bills get rated, and there are things in bills that cost the Treasury money and things in bills that collect money for the Treasury, a lot of the things we've talked about take money out of the Treasury, defers taxation, allows people to make higher contributions pre-tax, allows people to save more tax deferral for retirement. And so that all costs money. And so in order to rank a bill and have the cost come down, they need to have provisions that gather money. And so one of the provisions that was intended to gather money for the Treasury was to say, if anyone in your plan makes more than $145,000 and you allow catch-ups, which I don't know a plan that doesn't allow catch-up contributions, then you're required to offer all participants the option to make their catch-up on a Roth basis, whether they make $50,000 or $100,000. So if you have that one person that triggers that requirement, everybody gets to choose Roth for their catch-up, if you don't already offer Roth as a catch-up. But people who have compensation over 145 have to make their catch-up on a Roth basis. Again, why? Because that means that the money comes into the Treasury on the salary tax now, and they'll worry about the impact when I take the money out 6 years from now when it's no longer taxable or the taxation is different. There are lots of different questions, and there was a lot of uproar about this. So they've taken a pause, and it's not going to be implemented until 2026. So another confusing provision. Oh, I guess one thing that I forgot to mention, there was a typo in the catch-up section. You have to go back, but the catch-up section in the law that eliminated catch-up contributions. Obviously, I don't think anybody in Congress thought they should be eliminating catch-up contributions when they were expanding them and adding them and raising the limits. So Congress has written a letter saying, oops, typo, yeah, we'll fix it. Nobody intended to get rid of catch-up contributions. So that should be clear. Okay. So there's a lot of pressure, I think, to encourage people to save. And as everyone knows, most people don't save for retirement until, usually if they're young, until somebody triggers a requirement for them to save or encourages them to save. And so there's a lot of push to have provisions that make plans mandatorily enroll people and automatically take money out of their income, only allowing them to opt out. The idea that if you put me in a plan, I'm more likely to save and not do anything than if I have to do something to get into a plan. But at least for many clients, the real question is, well, what makes a plan? Well, two things. What makes a plan newly created? Is an employer joining an old plan, a newly created plan, because it's a plan for that employer? Unclear. The law also says that this section applies to plans maintained by more than one employer. And so for those of you who complete 5500s, you know that there are multiple employer plans and there are multi-employer plans, and multiple employer plans are not collectively bargained. Multi-employer plans are collectively bargained. It's unclear whether this applies to multiples, applies to multis, or applies to both. And so I know questions have been raised on the Hill to ask for clarification for that because the language and the headings are confusing. All right, so rounding out the back, again, with the idea that code provisions are tax policy, currently, a matching contribution is only made on an employer contribution. So it seems sort of obvious. I put money in the plan, my employer matches it $1 for every $5, and then I have more money in my plan. Under Secure, and this is a trend that first arose in governmental plans, which are not subject to the 401k rules and have begun to do this. Employers are permitted, not required, but they can add as an option that if an individual employee pays their student loan payment, that gets treated as if it was an elective deferral, as if it was a salary deferral for the purpose of making matching contributions. So I pay $200 before this change. I pay $200 to my student loan servicer. The plan pays my account nothing because there was no match because I didn't pay anything to the plan. For plans that adopt this new provision, if I pay my loan servicer $200 and the plan has a match, say, of 10%, the employer will put $20 as a match into an account for me under the 401k plan. Obviously, I'm not going to discuss the social policy issues here, but this is, giving a preference in tax treatment to people who go to college when there are a lot of other valuable uses of money besides retirement that it does not recognize. So that's the policy question. Is treating college loan payments special, good policy or bad policy? So this is intended for very for lower income people, and it's not going to take effect for a couple of years because it's complicated and it kind of is a complete departure from how the retirement system currently works. But starting in 2027, people are going to receive a credit from the federal government. This is federal government money, which is why it was deferred because it costs something. They're going to receive a credit as a matching contribution into the retirement account that they choose from the federal government. The idea that many people are not in employer plans that allow them to save, many people are not in employer plans with matching contributions. This is a mechanism for people to improve their retirement savings with a little help from the government. The participant chooses which of their accounts it goes into, probably an IRA. If they're very low income, in order to have that money there, and it can't be more than $2,000 gets contributed. So this is not a mechanism to put tens of thousands of dollars away. This is just going to be a limited match from the federal government for people who meet the standards. All right, notice there are themes throughout Secure to make the notices simpler. I guess my anecdotal observation is that there is always a tension in laws which inevitably add multiple disclosures you're supposed to give, and then ask the departments to simplify the disclosures and make them shorter. So usually they add 10 pages and then they say take away 2. So you almost never end up with fewer disclosures than you did. But these are, again, efforts to make the disclosures for defined contribution plans better and clearer regarding target date retirement funds, which are the most common kind of 401k option offered, as well as consolidate notices, meaning we'll have fewer notices or we'll put more notices within a single envelope so that the process will be simpler and cheaper for plans. And then similar theme, something that applies generally more to single employer plans and multi-employer plans. So this is not going to be practical for many of you who are listening, but generally plans are allowed to send things by electronic disclosure, meaning email, if the plan meets certain requirements. But the requirements generally relate to your access to a computer during your job. And so people who cut meat, people who work on a construction site, none of them have access putting their their cell phone aside, have access to a company computer to access items. So for the most part, these are not practical rules. They're trying to enable, I guess the changes is intended to enable DC plans to send at least one of the statements they send out quarterly to send it by paper. But for many plans, they're already sending it by paper because they're not able to use the electronic disclosure. So for those multi-employer plans still sending paper statements, this is not likely to cause any change in your behavior. And then another suggestion to look at disclosure requirements, make them better, and tell Congress good ways to make them better. And then finally, we have another pop-up question. Do you work with Secure Act 2.0? Anyone who's an administrator, I think I know the answer you should get. All right, so I'll cover the last piece, which is first, a rule that only applies to non-collectively bargained employees, meaning if the individual is collectively bargained, the rule we're going to talk about does not apply to them. However, it does apply to non-collectively bargained individuals in bargained plans, i.e. the fund office staff, typically the staff of the union, typically maybe some management people at a participating employer who also participate in the multi-employer plan. And the current law says, and this was added, I can't recall whether it was by Secure 1.0 or earlier, that if someone is not collectively bargained and they work part-time and they work at least 500 hours in 3 consecutive years, you have to let them into the plan to make elective contributions. The Secure Act reduces that to 2 years. So they have to work 500 hours in at least 2 consecutive 12-month periods. And obviously, if they're 16 years old and the plan says you have to be 18 or 21 to participate, they have to have the age. But it's intended to shorten the waiting period for elective deferrals that I guess Congress perceives plans are waiting people or think are making people wait a long time to spend their own money. In my experience, plans have no issue in letting people in early for elective deferrals. It's the employee's money. What they want to do is wait for matches and other employer contributions, which is the employer's money. And so I've not seen this to be a problem, but if you have large plans and they have very long or restrictive waiting periods for non-bargain part-time people, you're going to need to make an update. Jim?
Okay, thank you very much, Sharon. And thank you to all of our speakers. Now let's move into our Q&A session. I'll pull a question and any one of our speakers can feel free to respond to them. So let me pull this one here. What is the current latest mandatory age under the Internal Revenue Code for retirement benefits to commence?
Well, it depends on when you were born. It could be 70 and a half. It could be 72. It could be 73. It could be 75. But the slide has the dates based on when you were born. That'll determine what your required beginning date. Currently, assuming that you've not reached the required beginning date yet, it's generally the later of age 73 or the year you retire.
Okay, thank you. The next question. What is the biggest difference between defined benefit and defined contribution payroll audits? So thinking, David, that's probably directed to you.
Yeah, so from a payroll audit perspective, the biggest difference would be that a defined benefit contribution is typically based off a formula on a based off of a fixed rate dollar, so hours worked versus hours paid. And then a defined contribution payroll would be based upon a percentage of compensation.
Got it. Okay, thank you. Question number 3. Any advice on implementation issues for lease standards? It's like an accounting question.
Not for me.
I'll take that one, Sharon. Yeah, so I think one thing And I mentioned this when I was presenting, is just making sure, I mean, the leases that you've got in place for space and equipment are pretty straightforward. But I think taking a look at contracts for services that are provided and making sure there aren't any components there that incorporate a lease, just to make sure that you have a complete picture and representation of all of the leases, to make sure that you are performing calculations to get to that total value of the right of use asset and the lease liabilities. That's going to be one of the biggest things that you need to make sure you've done. And even if you've already gone through 1 year of this and you are then looking at a contract and realize you missed one, then it's, you can add it. So that's going to be one of the biggest things. Thanks,
Got it.
Jim.
Thank you. It's like back to a legal question. Is it true that under Secure 2.0, an eligible inadvertent failure can be self-corrected under the code's EPCRS at any time, regardless of how long ago the failure occurred, provided that the failure is corrected before it is identified by the IRS and it is corrected within a reasonable period of time after it is discovered?
Yeah, the short answer is yes. Most important piece of that, you have to find it before the IRS does. If the IRS finds it, then all bets are off. There's an entirely different correction process.
Got it. What is the difference between a desk audit and an on-site payroll audit?
So the biggest difference is that for a desk audit, we're typically conducting it remotely. And on-site would be on-site with the employer or their contacts. And we do find that we have a faster rate of success, I guess, in completing the audits when they're conducted on-site. But we find that it's a bit more challenging these days to get contacts to schedule on-site now that after COVID, a lot of people started working remotely. So I don't think that we're getting invited to people's homes to conduct these audits too often. So that's the main difference between desk audits and on-site audits.
Great, thanks, David. And the last question that we have is for Sharon. I know because it says, hi, Sharon. So under Secure Act 2.0 regarding recoupment of overpayments made to deceased participants from beneficiaries. If the plan pays benefits for the month in the current month, example, the December payment made to the participant in December, and the plan discovers in December that the participant died in November, is the plan prohibited from attempting to collect the November payment or just cannot recoup it from a beneficiary?
And there was a follow-up to this question too, Jim, clarifying.
I saw that. Yeah, I kind of incorporated that in the question. Right.
Okay, I'll give legal advice and I'll give practical advice first because that's frankly more important. In general, if you catch it that quickly, you can go back to the bank and have the bank pull it out because the bank will generally know that the participant is deceased. If that went into a joint account, I would still try to go back in. What probably is not going to work is sending demand and say it's a single life annuity. What's not likely to work is you sending a demand letter to the spouse saying you have to pay me or I'm going to go after your house. You have to pay me and, give me interest. But I think the simpler ways that plans have gone to collect after death, I think the general legal explanation is that you would view not so much that there's culpability, but that the spouse knows the participant is dead and the spouse knows that money shouldn't have been paid. And so in theory, the rules preventing you from taking that money back don't clearly apply.
Got it. Okay. Thank you, Sharon. So that concludes our conference for today. Thank you for joining us, and please look for the email with details on how to access the program materials and to request the 2.5 hours of CPE credits. We hope you found the sessions valuable and look forward to being with you at our next event and at the 2024 Employee Benefits Plan Conference. Have a great rest of the day.
Thank you.
Bye, everybody. Thank you.
Take care, everyone.